The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
We've looked at evaluating sideways moves in the market. We've looked at breakout trading. We are now going to spend some time on focusing our attention on trading a range. Once a range has been identified, one can consider a range trading approach. Very important that as your first step, you identify the boundaries of the range. This will also help in identifying your support and resistance levels, always an important aspect in whatever price analysis you are doing. And essentially, it's pretty straightforward in terms of how you trade a range. The strategy involves selling at the top of the range and buying at the bottom of the range. The objective, once you've taken on that trade, will be the opposite end of the range. Very importantly, we are stressing that a range trading approach means you trade the extreme ends of the range, selling at the top, buying at the bottom. Avoid trading when price is in the middle of the range. This is generally seen as an area or an environment where whipsaw risk is very high. It's very difficult to manage the trade from a directional perspective, because you're essentially in the middle of the range. You're not quite sure where to place your stop loss, unless, of course, you're placing the stop loss at the outer extreme of either the top end of the range or the lower end of the range. But that would then potentially make the trade unfavorable from a risk-reward perspective, because, once again, you're in the middle of the range. So avoid trading when price is in the middle of the range. This is an area where whipsaw risk is very high. Let's take a look at this particular example over here. Now, we can clearly see that the market has been moving sideways. Just by simply observing price action, we can identify a pullback from this level, pullback from this high over here, a rebound off this low, a rebound off that low, and more recently, a pullback off a high level, very close to the previous two resistance levels. Once you've made that observation, you can establish that the market has defined a range, and you can clearly identify the range by simply drawing what you would determine to be your best fit line with respect to the upper end of the range as well as the lower end of the range. By having done this, you're then clearly identifying where your resistance levels lie, excuse me, as well as where your support levels lie. So very important that we identify the support and the resistance levels. These will necessarily highlight the outer bands of the range. So by having established and located, or identified rather, a range, you can now adopt a range trading approach. It's important to note as well that you've asked yourself the question of the width of the range. Does this offer a decent trading opportunity? And in this instance, it certainly has, given the width of the range. If you just simply look at more recent activity, if we'd been fortunate enough to sell at this level, taken profit down here, bought once again, closed the position up at this level, sold once again, closed the position down at this level, bought, closed somewhere at the top of this area, potentially would now be short, and we would know that the objective on this trade is down to this level. So the width of the range helps us decide whether a range trading approach is appropriate. Now, we will look at order flow and what is the concept of order flow. From a financial market institution perspective, if, for example, you were looking at a major investment bank, the order flow would essentially be the orders that the market maker has on their books. This information, unfortunately, for the likes of you and I, is not readily available. The challenge, though, for us is to try and establish order flow information by assessing prevailing conditions in the market. What we can do is we can accurately identify the relationship between price action, market sentiment, and fundamental drivers. If we're able to do this, we can get or at least draw some conclusions about what information exists relating to order flow in the market. So, for example, if you were looking at a particular level that on multiple times had provided resistance for an instrument, it's very clear that market participants would be aware of this. It wouldn't come as a surprise if you were to find out that there would be a large number of buy orders above the resistance level, because the market would be anticipating potential strong move to the upside if prices break above that level. So by being able to observe key elements within price action, you can draw some necessary logical conclusions which would relate to order flow. So accurately, or being able to accurately identify the relationship between price action, market sentiment, and fundamental drivers can help in terms of assuming certain information relating to order flow. Let us see how we can overcome this challenge. Firstly, liquidity. We need to ask ourselves, is the market liquid? It's very important that the market is liquid, because this means that you have a good balance between buyers and sellers. In other words, orders can be filled. It makes no sense if there are a whole host of orders in the market, but nobody is looking to take on the other side. Always be on top of your price analysis. If you know what you're dealing with from a price analysis perspective, you can come to certain conclusions relating to order flow. Therefore, you need to study your price changes. As technical analysts, this is something that we need to constantly do anyhow. If you're looking at certain instruments where volume information is available, for example, stocks, then this information could be relevant. So for example, if you are following a particular stock, let's say you're following Apple, and it has a very strong rally on a particular day, and you notice that volume has increased, well, that tells you that there was an increase in the amount of orders that went through to push price action higher. That would further reinforce the significance of that day's rally in price action, because there was real market volume behind it. Always focus your attention, or at least be aware of, important psychological round numbers in the market. These psychological round numbers are very important because they have a significant, or at least potentially have the potential to have a significant impact on the market's reaction to whether that level is broken or not. From a fundamental perspective, it's important that you are aware of the fundamental factors. In other words, you need to be on top of, or ask yourself, what are the key themes that are driving the market? Ask yourself what market sentiment you are dealing with. In other words, if we go back just to an earlier example in terms of what we looked at, if you come to the conclusion that the market is trending up and has indeed entered phase 2 of the three phases of a trend. You are aware of the fact that under these conditions, the market should continue to move in an upward direction. In other words, buying interest should be strong. The order flow that exists should be looking to buy dips on any near-term pullback. In other words, what that means is that the corrections or the pullbacks should be relatively shallow in terms of the depth of the pullback. If that is indeed the case, then that would suggest that the market is quickly coming in to capture buying opportunities when the markets pull back. That would then necessarily be an illustration of the kind of order flow that exists. If you were, let's say, thinking about what perhaps might be going on in a market maker's order book, as markets pull back, orders would be piling in to execute fresh long positions on those better prices. In other words, if Eurodollar, for example, was trading up and yesterday had been trading at 120 and for whatever reason is today trading at 119, then strong interest potentially could come in at these lower levels to look at pushing prices higher. In other words, if I was looking to go long as a big institution at 120, but I now see prices at 119, that then makes sense that this is a better opportunity for me to execute a long position. If we translate this type of logic and this type of market activity from a sentiment perspective, then with respect to translating it into price action, we should see relatively shallow pullbacks in price action, and the market should continue to move in an upward direction. If, however, pullbacks begin to become deeper than we would ordinarily expect, and perhaps markets are trading more in a sideways and choppy manner, in other words, volatility is going up, that could tell you that the order balance between buyers and sellers is perhaps more evenly balanced in the market, and that would explain why price action is not taking on any direction. So by simply evaluating price and applying your price analysis to the market, extracting what you perceive to be underlying market sentiment at the time, that could give you an insight into certain conclusions that you can draw about order flow. Certainly also from a market sentiment point of view, you can say to yourself, okay, I've read a headline, I've read a headline in the market that tells me hedge funds are starting the year with a record long position on Eurodollar, something that we looked at in an earlier webinar that was on Monday. You may say to yourself, okay, so from an order flow perspective, does this potentially mean that all the long positions are already in the market? In other words, if I translate that into market sentiment, is that potentially a warning sign that market sentiment is at an extreme? So we're simply using a logical evaluation to see how we can gather some conclusions around order flow. And this is how we can overcome the challenge of not actually having a physical order book in front of us to understand where the orders sit on our books and what potential impact they might have on the market in terms of, if broken, with respect to direction. Let's take a look at one example over here in terms of how you can use psychological round numbers to come to certain conclusions about order flow. Let's just take a brief look at the price action that we are seeing in front of us. So the market had clearly moved in a downward direction, and then for a long period of time had moved in a sideways manner. We also noticed that something occurred during this phase which saw prices move clearly or sharply lower. There was a surge in the depreciation of this particular asset, and then the market has moved higher. Before understanding what actually occurred here, we can really just conclude that from a price action perspective, 120, which is the horizontal blue line running across the price chart, is clearly a very significant pivot point for this particular market. We've noticed that from the sharp depreciation over the last few years, markets have started to recover and have now arrived at this pivot 120 point. If we were to see a break of 120, would we be surprised if we saw a strong accelerated move to the upside? Does this mean that there are significant buy orders above 120 because of the relative pivotal importance of this level? In other words, is 120 also an important psychological round number? Yes, it is potential, it is possible, and very likely that significant buy orders exist above that point. So by simply evaluating price action, we can come to the conclusion that market interest could peak further if 120 is broken. To explain what occurred in this particular chart, this is the euro against the Swiss franc. And for a long period of time, the Swiss National Bank was managing the value of euro Swiss above, or at least holding it above 120. You can see that this went on for a long period of time. In early 2015, it pulled the floor from euro Swiss, and that took the market by surprise, and we saw a sharp sell-off. The market has, over the course of the last few years, since 2015, gradually recovered to trade back to the 120 level. So we understand too the fundamental backdrop to all of this activity. We've done a technical evaluation on the market. Both would suggest that 120 is clearly a very critical level, and that if it breaks higher, we are likely to see a continued move in the uptrend. Whether this is a 5% move or ultimately a 10% move or even higher, it's not really relevant at this point in time. From an order flow perspective, we can come to the conclusion that buying interest would certainly, it's very likely that it would pick up if the market traded above 120. Until then, we also need to recognize the fact that there might be a failure at 120. If there is a lot of interest, or perhaps a lot of buying interest has already established itself in anticipation of a break of 120, and the markets start to pull back, and let's assume that we develop perhaps a much stronger downtrend, then these long orders in the market might be reversed or closed out, which would further facilitate a downward move in price action. In other words, we could have two types of order flow possibilities, one below 120 and another above 120. So be on top of your price by analyzing the price action, and also, if possible, be aware of the fundamental factors that are currently dictating the underlying direction in price. This can give you a lot of insight into sentiment, and from that point you can then come to certain conclusions about order flow. So 120 is undeniably a key level and will likely play an important psychological role in impacting sentiment if breached. It would not be a surprise to find that there are a large number of buying orders above 120, or that a break creates fresh buying interest. From a order flow perspective, in terms of the questions that you should ask yourself, is firstly, what are the key themes in the market, as we just focused on? Ask yourself again, what are the main factors driving market sentiment? What is price action telling me? Now, we will conclude today's discussion with a focus on price confirmation. The close should always be regarded as the most important of the four levels. You have the open, the high, the low, and the close. The close is regarded as the most important. It represents the conclusion of the day's activity from a decision-making process in the market, but it also represents the price that is used most significantly in the various technical indicators that one has access to. When you are evaluating anything, if a technical development has occurred, whether it's a reversal price or a reversal pattern or a continuation pattern, or the break of two moving averages, which indicate to you a change in the direction of the trend, you need to develop your level of conviction once these price developments have occurred. In other words, just to give you a couple of illustrations, if you were looking on the confirmation of a reversal pattern, you may say to yourself, okay, the break of the neckline needs to be cleared, but we need to see at least one trading day close below the neckline to provide confirmation. If you were using a moving average crossover technique and you notice that your shorter moving average crosses above your longer period moving average, you may say to yourself, well, we need to see at least 3 days for this condition to be intact before we'll regard it as a confirmation. That will determine your level of conviction once these key developments have occurred. By being able to determine your level of conviction, you're then able to further reinforce that by the requirements or the filters that we've just highlighted in terms of confirming the price development. Just another additional example. Do you, for example, need to see a daily close to confirm a break of a significant level? Some people might say that an intraday break is fine for me. Others might say I'm going to wait for the daily close because that will determine my level of conviction on that price development. As always, it then necessarily means that you will need to apply your technical chart analysis and also use your indicators such as oscillators to get an overall bearing of what you perceive to be happening in the market at that point in time. With respect to price confirmation, liquidity once again is important. If we are to see a breakout, the fact that that breakout or that price development confirmation for it to be valid needs to be in a liquid environment. Otherwise, it will turn out to be a false warning. Okay, you've heard of perhaps terms such as bear traps or bull traps or a false breakout. Liquidity will also play a role as to whether these developments do occur. That then concludes today's webinar, webinar 11 of the 12 webinars that we have in this Advanced Technical Analysis course. In today's webinar, we looked at understanding price ranges. We focused our attention on managing price ranges. Then we looked at understanding breakout trading, how to trade a range, certain aspects that you need to take into account when trading a range. We looked at order flow, questions to ask around order flow, and we've ended today's discussion with a brief look at price confirmation. In tomorrow's webinar, the third of the 3 workshops, we'll be following the same logic and principles that we've been applying for the previous 3 workshops. In other words, looking at illustrating how you can incorporate technical analysis into a solid trading plan. The idea behind the course is for you to be able to develop robust skills necessary to more effectively read market conditions, and there will be some additional final considerations over the course of the webinar. Congratulations, everybody. You have now finished webinar 11 of the Advanced Technical Analysis course. This has been a focus on range versus breakouts, order flow, and confirmation. Thank you once again for joining us, and we look forward to seeing you next time, which will be tomorrow. Bye for now.